We have a flight now.
Don't touch me. Ken, can you hear us?
I can hear you.
Perfect. Hey, Ken.
Perfect. Thank you.
Can we do that? The problem is I don't have city credentials. I just don't.
Yeah, you go on the city website and find the link on there, unless you need to.
Yes, I was the summer intern for the finance department.
Awesome.
And what is the summer intern?
Soon, I go back next Monday.
And what's back? Back to the students?
Yeah, back to the office station. For this business, that's a year's analyst.
Mhm.
Meeting is being recorded.
Sorry, you said Boise?
Yeah, for you.
Oh, awesome.
Sorry, I'm just more like trying to. Okay, okay, there we go.
Hey, Leslie.
It's 6 o'clock, you're
Not
talking.
gonna be you have to start the meeting.
Yeah.
What?
Yeah, sorry, so Deepak's 15 minutes late,
Oh.
so you get to be in charge to get there.
Okay.
How are these guys after you? Okay.
Cockroach quorum? Vice Chair Zhang? Here. Commissioner Chang?
Present.
Commissioner Fowler?
Here. Here.
Commissioner Otis? Four commissioners are present, we have a quorum. All right, so pledge of allegiance.
Real flag.
I
pledge allegiance to the flag, United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Public comment. Nope. Moving on to the draft commission minutes for the last meeting in May. May I have a motion to approve the draft minutes?
So moved. Seconded.
Motion by Commissioner Otis, seconded by Commissioner Chang. I'll call the one. Vice Chair Zhang. Commissioner Chang. Commissioner Fowler.
Approved.
Commissioner Otis.
Approved.
The motion passes 4-0. Next is the investments report. Is this the one we reviewed and discussed? Or this is a new one?
So this is the report for the quarter ended in March. We're supposed to have our representative of our investment firm on, so we're gonna see if we can find him. Just leave this.
Is he the one that can make it?
No, he's having trouble. Looks like he's on. Let's see what
So this is the city's investment report for the quarter ending March 31st. And for this report, Steph added the city's other short-term investments, including late, SIP accounts, and CAD plus, to provide a more complete picture of the city's investment portfolio. So as soon as Johnny is on board, he's gonna walk through the his portion of the portfolio management. Thanks.
About half, that's with PT. No.
Good afternoon. Can you hear me?
Yes.
Yes.
Okay. Apologies for that. I try to be a little better, a little more savvy with Zoom, but it's great to see you all. Let me set my, give me one moment, get my camera up here.
Joining, John.
Okay. How are you?
Sounds
Good.
Great. Uh, Thanks for having me on this afternoon. And Jesse, I heard you mentioning, I think, talking a little bit about the portfolio. Would you all just like me to jump into our review or any thoughts from the commission?
We're ready.
All right. I'm going to try to share my screen here. Pull up the report. So what I'll do is if the commission's okay with it, we'll just do a couple of minutes of an economic update as we've done in the past and share our thoughts on interest rates in particular. And then we'll jump into a portfolio review and we'll talk about transactions, the structure of the portfolio, and then we'll talk about the total return as we've implemented that into the performance as well.
Sounds great.
I've sent a request to share my screen, so I don't know if there's something that you may need to.
It's done.
Try it again, John.
Okay, hopefully you can see my screen now.
Yes.
All right. So just a couple of thoughts on the economy. GDP was released for the second quarter just a couple of weeks ago. And really the highlight I wanted to mention to you all this evening is, so growth slowed just a bit from 2.1% for the first quarter down to 1.5% here through June 30th. And just a couple of key takeaways. On a good note, consumer spending actually picked up. It was the highest contributor to GDP since the fall of last year. So since September, the third quarter last year in September, the last couple of quarters we'd seen consumer spending slow down a bit. In the first quarter, you may recall with that 2.1% GDP, interestingly, that quarter was driven primarily by business spending. And I'm sure you all very familiar with the tech sector being the big contributor. Hundreds of billions of dollars have been spent on AI-related spending, certainly in that first quarter. Slowed down a bit, but business spending was down a bit from the first quarter, but still positive. But again, it really shifted back to consumer spending being the primary driver, which is generally the case. And in spite of higher prices across the board and inflation that seems to not be able to move closer to that 2% target, consumers continue to spend and propel the economy forward. So that is good news, although it's interesting to see with spending, debt levels continue to increase for the consumer. And I do read many articles where the consumer is being taxed, if you will, from higher prices across the board. But nonetheless, GDP was remained positive in that second quarter. And then a couple of thoughts here just on a couple of economic indicators. One is of course the labor markets, which is a very important indicator and a driver of our economy. We need to have jobs to spend, and we've seen weakness in that sector in the last couple of months. We saw some weakness in the fall. We saw interest rates trending lower in that time frame, if you recall, and a lot of thought of the economy slowing down and the labor markets really going into a slower growth mode, if you will. And then we saw that pick up in the beginning of 2026 and had some healthy, well, February was not great. February was a negative job month. But other than that, through June, we actually had pretty strong job growth, especially compared to the prior year. And then that has slowed down. And in fact, July, we saw a contraction of jobs by 23,000. That was a bit of a surprise to the market. And then the other comment I wanted to share on that was not only did we have negative job growth or job contraction in July, job growth for May and June was actually revised down by a total of 146,000 jobs. So it was a significant reduction in jobs than initially reported in May and June. So we've certainly seen a trend here in the last few months of slowing in the labor market. The unemployment rate you've likely read about recently as well. The last few months, that unemployment rate, pardon me, has remained very strong from a pure percentage perspective. It dropped to 4.1%, in fact, in July. And unfortunately, that's not due to necessarily a strong job market. It's due to a record number of individuals actually leaving the job market. And that's caused some concern for many economists. In fact, the labor force participation rate in that third bullet point dropped down to 61.1%. Actually, the lowest level since January of 21. So really, literally the lowest level of labor force participation going back to the middle of the COVID pandemic. And so there have been a number of articles on folks that are not in the workforce, choosing not to even look for jobs. And I actually read an article today, in fact, that a lot of that is actually with men between the ages of 16 and 24. So we've got a lot of younger men that have, for one reason or another, are not looking for jobs and participating in the labor market. So that's a bit of a concern as well. So slowing jobs, we had a contraction in July, and that bigger story, I think, from a macro level is the overall labor force participation rate, which is just simply a measure of working age, generally thought of between 16 and 64 individuals that are actually working or looking for work out of the total population in that age group. And so the other thing that let me pause. Any thoughts from the commission so far? Okay. And then the other comment on this slide is just the consumer sentiment and confidence. And I think this ties really into, slowing labor market as well as those higher prices I mentioned. And we've seen both from a sentiment and a confidence, both of these indices are showing lower levels, just showing that the consumer, whether it's through personal financial situations, which is really that sentiment, or more macro level questions and thoughts from the confidence survey, both of those are a bit lower than they were in the last couple of years. And again, likely just due to higher gas prices, food prices, and so forth, and weighing on the consumer. And that's being reflected in those two surveys. Gas prices, as we know, have increased substantially since the Iran conflict and the closing of the Strait of Hormuz. And as that drags on into the 6th month, we saw gas prices spike. They came back down through June, but you likely have seen, like I have, they've pushed back higher. So gas prices remain elevated. and not just from gas, but also from diesel, which is in that blue line on the top there. And why that is important, of course, is all the diesel that's used for trucks to ship these products around the country to get to us as consumers. So the thought is, and I think this is what continues to weigh on not just the consumers, but market participants, and why interest rates continue to remain higher than they were, is that these higher prices will likely impact everything that we're buying, as is, diesel and fuels used for everything that we participate in, and likely going to keep prices a bit higher until those gas prices and diesel prices come down. The chart on the bottom right here, just wanted to show you our portfolio team and economic teams were looking at this for the last few months, and it just shows the price of, and I'm not a fertilizer expert, but the U.S. Gulf Euro granular spot price. So this is a fertilizer that comes out of that part of the world. About 20% of fertilizer that comes through the strait. That lighter blue line on that bottom chart just shows those fertilizer spot prices were, closer to 300 prior to the conflict, spiked close up almost to $700 a couple of months ago. They've come back down a bit, but and if we look at that chart on the bottom right, that 902 figure, that was actually the beginning of the Ukraine-Russia war. So again, same area, and that caused prices to spike with that fertilizer. And we've seen that again more recently. And just showing that, because we're showing gas prices spiking and we've got higher fertilizer prices, again, all of these things contributing to the prices of everything we're buying, but in particular food and crops that are growing and needing that fertilizer around the world for these crops. So those are a couple of indicators that suggest that inflation may remain high, at least for the near term. And then just a couple of slides on interest rates. Of course, this is the Fed funds rate that we're showing for the last 26 years, going back to 2000, where that overnight rate was as high as 6.5%. And then going through the global financial crisis, we had the dot-com bust that pushed rates down to 1%. Then we had rates move back higher. The financial crisis in 07, 08 pushed those rates down to zero. And as we go from left to right, of course, we were at a high of 5.5% just a couple of years ago. And then in the last fall, the Fed did the most recent cuts, 3 cuts last fall, bringing that rate from 4.5% down to the current level of 3.75% for the overnight rate. Of course, that's important because it governs the city's liquidity funds and how much you're earning in money markets and local government investment pools, but also just short-term rates overall. And so thinking of that overnight rate and the shift of really where we were back in February, where we are now, this is what this is showing us on the left is Fed rate hikes or cuts. And on the left-hand side chart, you'll see back in February of this year, there were 3 rate cuts priced in really through July of next year. So over the next 18 months, the market was forecasting potentially 3 rate cuts. Since that time, this red line shows at the end of July, it's not quite as aggressive now, but the market had been pricing in between 1 to 2 rate hikes, really potentially as early as the end of calendar year 26. That number has come down a bit in the last few weeks, primarily because you likely heard inflation came in at 3.4%, so a little lower than what was expected. That was helpful. And then with these slowing labor job growth numbers, also suggesting to the market that the Fed may not need to rate hikes as aggressively as maybe thought of just a month or two ago. So right now, the market's pricing in maybe 1 rate hike through the end of 2026. But even with a single rate hike, it is a drastic change and shift in thought on that overnight rate from earlier this year, specifically before March, before the Iran conflict began, and where we've been in the last several months. And so what does that mean from an overnight rate perspective? That's on the right-hand side, where we see instead of being potentially 3% or less by the end of this year or into early next year, the market is now expecting that overnight rate to be potentially 3.75 where we are now, potentially maybe even going up to 4%. A lot can happen, of course, now between now and then. And The other thing I'll mention here on this particular chart, and you may have read about this with the new Fed Governor, Kevin Warsh, he's really taking a change in the approach that the Fed takes with regards to messaging of that overnight rate. He actually has not even voted for the dot plot that they've used for many years. I think he's suggesting that they get rid of that dot plot, which they release pretty much every quarter, which the idea of that is to give the market an idea of what the Fed members are thinking with regards to where that overnight rate would be in the future. He's also talked about eliminating the press conferences for the Fed governor. So really limiting any sort of guidance that the Fed might have between these meetings, which is a drastic change and really takes us back to before Bernanke when they started instituting some of these messaging concepts to be a little more transparent. Kevin Warsh is taking a different approach to that. So that remains to be seen how that plays out for and how the market reacts with these different meetings. The next one, of course, being in September. And so looking from the overnight rate, again, at 3.75%, with the expectation it may stay at that level for the next couple of months, maybe a rate hike if inflation starts to pick up or if there's a pickup in the labor market. But from an interest rate standpoint, and this is showing us Treasury rates going back over the last couple of years, but I'll focus really on the right-hand side of this chart, and I've highlighted that gray line is the 5-year was at 3.5% at the end of February. The 2-year was at 3.38%. And you can see these interest rates were drifting lower really for the better part of a year, going back to February of 25. And then, of course, with the conflict, with the closing of the Hormuz, with the gas prices and inflation fears, we can see interest rates have picked up by almost 90 basis points from February through August. This is actually updated through today. In the last couple of weeks, we've seen rates maybe come down a few basis points, but generally up well over 80 basis points from February. So that while that's not great for borrowing, it actually has been very helpful for your investment program. And as we've reinvested over the last several months, we've been able to reinvest at rates that we hadn't seen in over 12 months or so. And so we'll talk about that here in a moment. And lastly, just wanted to show you what does the Treasury curve look like from just before the conflict of this year to actually as of today. And it's really just showing how the curve has begun to steepen. And we've got a positive slope to that curve, which is a nice thing to see. We've seen this now for a couple of months. But you may recall for the better part of 2.5 years, I think it was the longest period in recorded history that we had an inverted curve in the treasuries in the short part of the curve. Really unprecedented time frame that occurred. In fact, I'll just jump back one. Let's see here. Well, I was going to try it. There we go. If we look at this chart, now hopefully you can see my cursor really just before the conflict where I'm showing the 3.5 and 3.38. Wherever this lighter blue line was higher, and certainly the green line, which is the 3-month T-bill, that was showing us shorter term rates much higher than the 2 to 5 year area of the curve. So we had this long period of inversion. It actually goes back further than this chart shows. So quite an interesting time of an inverted curve, especially the fact that we didn't have a recession, at least not one that's been recorded at this point. And so now we're seeing a steepening. Again, that's great news for reinvesting for the portfolio for the city, especially as the longer term investments out to that 3-year area, picking up some higher yields than we've seen in several months. So those have been of my talking points on the economy. Again, GDP, good news is we continue to grow. Inflation coming in a little less than expected. That's also good news. But I think the challenge for the Fed and the overall market is likely going to be just higher prices and a potentially weakening labor force, which could cause some slowdown in consumer spending and slower economic growth looking forward. Although we've seen that in a few quarters in the last couple of years, and we seem to rebound. So hopefully we'll continue to see positive movement there. And we'll see the labor markets start to pick up steam. You pause there and ask the commission if you have any thoughts on this part of the presentation or any questions for me. Okay. Well, thank you for the opportunity. Oh, I'm sorry.
Just a quick question. So with the change in expectations with respect to rates, should that have any bearing on our investments, like duration or anything?
That's a great question. So our approach is really just to now let me jump into your longer term portfolio because I think it really applies more to that one. The short term is by design where we're laddering out 12 months, a 12-month ladder. So with the question of with the change in interest rates and the steepening of the yield curve, it plays a bit of a role in it, but I want to make sure that we address the duration. So the duration of this portfolio is right around 1.8 years, and that is the target. So we generally will manage around that 1.8 year part of the duration curve or of the curve, pardon me. By design, we're not going to adjust your duration strategy significantly. In fact, you see it actually was a little bit lower from where we were in March, although during this quarter all of our reinvestments were actually between 2.5 and 3 years. So we did pick the back end of the curve, if you will, for this portfolio because we saw the steepening of the curve. So the portfolio manager will look at your current holdings and look at reinvestment opportunities and make those selected trades based on primarily focusing on 1.8 year duration, not deviating much from that, but also looking at the shape of the curve as well as what certain yield options are. So for instance, in this quarter, and part of my couple of my discussion points for you all this evening, when we look at the reinvestment of the long-term portfolio, so again, we rebalance it pretty much every 4 to 6 weeks to maintain that target duration for you all, not to try to time the market, but when we do see market moves and opportunities, we certainly want to take advantage of those. And so for this particular quarter, we actually utilized the credit markets a little bit more, and we bought some corporate notes in a couple of asset-backed securities, which are all, of course, permitted. AAA rated asset backs included, we bought Toyota Trust asset-backed security. We bought Bank of America credit card asset backed, and then Chase credit card. So we generally are within the auto and highly rated credit card asset backs. That's really the space that we focus on. We find that those are we like that because you can pick the pool of borrowers in those loans by credit score and so forth. So and again, we're staying in the very top tier. We also bought Citigroup, Nvidia, and an issue by British Petroleum in their capital markets. So we focused on some corporate and credit during the period, and the yields on those securities, just looking at those, were anywhere from 4.08, pardon me, to as high as 4.45%. And generally, those securities were providing, depending on the issue, these maturities, again, were very close to 3 years, 2.5 to 3 years during the period, and provided anywhere from 35 to 45 basis points over a comparable maturity U.S. Treasury. So we did buy a few treasuries as well to continue that diversification. But long answer to your question, but it did tie into the notes. We focused on the 2.5 to 3 year area. In other quarters, we might be closer to the 1.5 to 2.5 year area. But again, steepening curve, higher rates allowed us to focus on the back end and then using some of those corporate names that we like as part of our review to add some additional yield to the portfolio. Again, in fact, the only security we bought that was less than 4% was actually at the beginning of the quarter when rates were just starting to pick up. And that was a treasury note that was at 3.78%. And all of the other securities during the period were, again, over 4%. That's going to really help continue to increase the book yield of the portfolio and increase income opportunities going forward.
Thank you. There has been a lot of debt that has come on the market, the corporate debt, because of all the capex that tech companies are spending. They're issuing, and this prediction of even more. That
Yes.
must have an impact on our thinking.
Absolutely. And that's the important thing to mention, with a couple of these names like NVIDIA in particular, and I'm just looking at some of these names, but we do always want to be diversified within that space as well. So, looking at technology, looking at consumer, we bought a Walmart bond, looking at a couple of these other issues, as I mentioned, like the Bank of America credit card. So being diverse is important as well, so that we're not overweighted in any particular name or any particular industry.
Thank you.
Yes, sir. And so looking at the portfolio from an asset allocation perspective, very diversified, about 45% in treasuries. And then we can see some corporates and asset backs, and then a smaller allocation to some GSEs. And just as a reminder, GSEs represent government-sponsored enterprises, and those are Fannie and Freddie and home loan bank issues. We used to see a larger percentage of those issues in our portfolios, but just given the structural change with those GSEs, they don't issue as often, number one. And then the second comment on that is that the issues that come to market in many cases are trading at or in some cases even below U.S. Treasuries. So we'll tend to favor the Treasuries over that. And then just a couple of remaining holdings of some corporate CDs that were bought a couple of years ago. Looking at the distribution of this portfolio, so by design, we'll generally have a majority of these assets in that 1 to 3 year area. We've got a smaller percentage in the 3 to 4 and 4 to 5 year area. Part of that were just some prior security purchases as we were looking to find and working with the city, and some of these notes purchased before we took over the portfolio. But so you have a space out to 5 years, but generally what we'll see, because we have this 1 to 3 year strategy in place now that we've had in place for about 6 months, is most of the assets will be in that 1 to 3 year area. And then as securities move closer to maturity, we'll reinvest and move those back out between the 1 to 3 year area of the portfolio. So you'll see, again, generally almost 100%. Sometimes we'll hold securities a little bit longer. For instance, you see these CDs, these one actually just matured in July, a couple of CD holdings that were bought back in 23 when rates were above 5%. So those CDs were paying yields of over 5%. So rather than sell those, we've held those in the portfolio, providing that income on a 5% annualized basis. And then we'll sell some lower yielding securities to reinvest to maintain that duration. So that's another strategy that we'll utilize. So we'll sometimes see. Yes.
Yeah, I have a quick question. So I was looking a little bit behind, but I'm looking at the portfolio overview, and so I don't know. Are we going to get into the overall portfolio return? And I'm very interested in the fees also. Net, was a return of net the fees off the portfolio?
Yeah, great question. So I was working with Jesse on this to confirm. So just from a compliance perspective, and as a GIPS compliant investment manager, we just needed to verify the inclusion date for the portfolio. So if we look, let me zoom in here. So I'm sorry, this is a little bit small. So as you recall, we established the portfolio with this 1 to 3 year strategy. Your benchmark is this 1 to 3 year AA to AAA corporate and government index, meaning this benchmark is an industry standard benchmark. We pull this data through Bloomberg. This is actually through your reporting platform, but
What page is it? I can't read though. What's on the screen?
I'm sorry. I'm trying to zoom in here. Is that any better?
Yeah.
So the good news is, so what we're showing here is monthly, the quarter ended June, and then the 6 months ended June. So this would represent from January through June when we began the total return performance calculation. So for it's in bold. It's just the way the system presents it. The top line is actually the benchmark return, and then this bottom figure is your portfolio return. So for the month, the portfolio outperformed. We generally don't like to look at just a month. We generally like to look at longer period of time, but we're new in this calculation. So if we look at this most recent quarter, the benchmark returned 0.395 or 39.5 basis points. Your portfolio.
Since this is gross of fees,
Yes.
I'm interested in what net of fees the returns are.
Yeah, so I can talk to that. But we have to show it gross of fees, but our fee structure is around 5 basis points, slightly less than 5 basis points. So if we took these rates net of fees, you could say for the quarter, I'd have to do the math, but because, these are not annualized rates. These are quarterly rates. But even if we looked at the 52 basis points, I don't know if you can see my cursor, but for the quarter, the benchmark was 39.5 basis points. The portfolio was 52. If we took 2 basis points off of that for our fee for the quarter, it would be approximately 40 basis points for the benchmark and then 50 basis points for the portfolio for the quarter. And then if we look for the first 6 months of this total return, the benchmark was 69, just close to 70 basis points return for that 6-month period. And the portfolio, pardon me, was just 92 basis points. So if we took 2.5 basis points for that, then call it 89 basis points just to round down. So a 69 versus 89 for the 6 months. So even net of fees, the portfolio did outperform the benchmark for the reporting period. And what I can do going forward is I can actually send that to Jesse so that you all have that, and I can simply net out our fees from the gross returns that we're required to report to you.
Yeah. I think it helps a lot for us to see both gross and net and understand that impact.
Yeah, absolutely happy to share that with you, and we recognize that. But I am pleased to report that the portfolio has outperformed the benchmark for the period, and going forward, we'll always have that Jan 1 start date, and we'll show monthly, quarterly, and since inception returns, and we're building that into your quarterly statement as well. So you'll see that right in the statement.
So we'll see a third row here, which will have the returns after fees.
In our reports, we have to show it gross of fees by rule, but I can always send that information to Jesse so you have it net of fees.
You're not allowed to add a row here, which is net of fees.
I'm sorry?
You're not allowed to add a row in this table, which has the returns after fees.
So in our reporting and by our compliance rules, because across the board, we show everything gross of fees, but I can also create a report for you to show that net of fees. It's just how our reporting requirements are set up for the industry. But happy to generate a report that does that. I just can't show it in the statement because we have to show gross.
We seem to have done well compared to the benchmark. And what do you attribute that?
So I think part of it, like when you look at a 22 basis point benefit over the 6-month period, I think part of that was just the structure. As you recall, we were restructuring the portfolio to get into this 1 to 3 year strategy. So we had a plan in place, and we had talked about a couple of different strategies. So part of that, I think, was maybe just a benefit of the existing portfolio. I think when you look at the last quarterly return, even at 12 basis points, I would anticipate our performance being similar to the benchmark and hopefully outperforming the benchmark. But I don't necessarily expect it to be 10 to 12 basis points each quarter or 22 basis points for that 6-month period. I think part of that was just fortunate how the strategy of the portfolio versus what was going on in the market. But obviously our goal is to outperform the benchmark, but we generally will be performing in line. If you see a portfolio way overperforming a benchmark, the first thing that would come to my mind would be like, okay, well, are you using the right benchmark, right? If you're really beating it by 20 basis points every quarter or every 6 months, you may not have the appropriate. But so I would anticipate a closer performance between the portfolio and the benchmark, but we'll take a outperformance, of course.
But what is refresh my memory what the benchmark is on this? This is in terms of total returns.
Yes. So your benchmark is this, it's called the ICE or ICE B of A 1 to 3 year AA, AAA corporate and government index. And this is an index that it used to be the B of A, it was the Merrill Lynch B of A, and then ICE, which is an organization, a pricing organization. They price bonds and provide pricing for those bonds to the industry. So they bought these indices. But this index is made up of primarily treasuries and agencies with maturities between 1 and 3 years. and then corporate notes that have AA and AAA ratings in a variety of them. So we wouldn't be buying every corporate note that might be in this benchmark. We're only buying those notes that our team reviews and does analysis on, that's approved for our team. But this is a benchmark that most closely resembles the strategy for your investment program, meaning the similar duration. The duration of this benchmark is generally 1.75 to 1.8 years, and then similar in asset allocation.
Okay, thank you.
Of course. Just pause. Any other thoughts or anything when we jump back over to the portfolio? So we did talk about the distribution. We have a couple of other maturity charts. I'm happy to talk to those, but also just want to make sure that we're showing you your allocation by ratings for both Standard & Poor's and Moody's. You've got very good balances. If you see a not rated, it just generally means some securities are rated by S&P and not by Moody's, or vice versa. And then they have ratings by Fitch in many cases, but you're highly rated, you're compliant with your investment policy. So we always want to point that out for you. And then on your distribution from the beginning of the quarter to the end of the quarter, so March 31st to June 30th, this is what the portfolio allocation looked like. And so the biggest really difference is, and this goes to what I was talking to earlier, we had some GSEs in there that matured during the period. So we had a decline in the allocation to federal instrumentalities. And so you see that change there of negative 3.13%. Again, a lot of that has to do with not seeing value in that space versus treasuries, or certainly corporate notes and asset backs. So we saw a decline in allocation there, small decline in allocation to treasuries, but it had everything to do with really looking at some of those corporate notes and asset-backed securities that we talked about during the period, adding some higher yield. And you can see some of the book yield on these by sector. The CD yields I mentioned earlier at over 5%. Those were back in 23 when rates were a bit higher, so holding on to those a little bit longer. But really the shift was from some agencies, instrumentalities, pardon me, and then a couple of treasuries that we sold, and then reinvesting in the corporate space to take advantage of those yield spreads.
So is there such thing as benchmarks for the short-term portfolio that we would compare? I know we're comparing benchmarks by some of the securities, but I just wonder about an overall portfolio.
So the ICE 1 to 3 year benchmark that I was highlighting, that is for this portfolio. Is that what you mean?
That's what I'm asking, yeah, because it is cash and CDs, and I'm just wondering from a portfolio standpoint.
So the benchmark that you have is related to all of the assets in this portfolio that has that average maturity of 1.8 years. So that would meet the same maturity structure, average maturity structure of the benchmark. So in other words, we're not measuring that benchmark to just these assets in the 1 to 3 year area. It's to the whole portfolio, given that the entire portfolio has an average maturity of 1.8 years. And I'm just pausing because I want to make sure if you're just thinking through it or want to make sure we answer the question.
Thank you. Yeah, thank you.
Okay. You're comfortable. And if you have any follow-up, let me know. If there's some other information I can share, I'm happy to do that. But it is based on the overall portfolio.
Actually, I'll ask one more question there. So the relative composition, not from a duration perspective, but the various kinds of assets, how does that match between the benchmark and our portfolio?
Yeah. So right now, the portfolio, I can pull up the benchmark statistics. I'll have those for you next time. I'm sorry I didn't pull those out. That it generally changes on a month-to-month basis, as depending on what goes into the benchmark and what rolls out of the benchmark each month, that's rebalanced as well. But generally speaking, that benchmark has generally, so you've got 26% in corporates and 19% in asset backed. So think about that as, 45%. I get that by math. Let's see, 26 and 19, 40% in corporate. So that's a bit higher than the benchmark. I'll pull those stats for us for our next review. That said, the benchmark also has a number of corporate issues that generally wouldn't fall into the scope of what we would buy, just because it's pulling in a universe of AA and AAA where we're limiting our investments within that space. But so long answer, using treasuries and agencies, much like your portfolio, the corporate allocation in that benchmark may be higher or lower on a month-to-month and quarter-to-quarter basis, but I can bring those stats for our next presentation.
Thanks, John.
Of course. The other thing I'll tie into it just for our discussion, I think might be helpful, is just to show the performance of each asset class. So I can run an analysis that shows how did treasuries perform, or how did corporate notes perform, and we can see over time there'll be quarters where treasuries will outperform and other quarters where corporates will outperform based on different market conditions and flight to quality trades and those sort of things that impact the overall return within these various sectors. And I'll put that into our presentation for next quarter. So those were highlights of the long term. I just also briefly wanted to touch base on the short-term portfolio. And again, if you recall, there was a target amount of around 20 million that was identified that would be needed potentially, on an annual basis, not necessarily annually 20 million, but that may be needed from fiscal year to fiscal year for certain capital project expenditures in the nearer term. And so we moved 20 million from that longer or operating portfolio into the short-term portfolio. And by design, this is laddered out between 12 months. So you can see here on our maturity distribution chart, pretty much just over a quarter and then slightly less than a quarter in that 9 to 12 months. But each time we have maturities, we're reinvesting these out along the curve for you all, unless we get notice that you are letting us know, hey, we're going to need some of these proceeds, then those would mature. And then you could move those out of the portfolio if you needed them for expenditures. And if I look at some of those trades, sorry about that, just pulling that off, reinvested around 6 million of this portfolio just in the last quarter. And you can see we'll do that again here through this quarter. So we see this maturing every quarter between 5.5 and 6 million. And we basically ladder these out. And we look for opportunities, not just for laddering, but also for some yield. So we've purchased some short-term commercial paper and a couple of short-term CDs with rates, just looking at rates that are between 4%, 4.18%. We're looking at some T-bills. Those have been a little bit lower because they trade lower, of course, than commercial paper or CDs. But keeping a diversified approach for the portfolio as well, but really focused on some T-bills and then commercial paper and CDs to help with some yield. And when those issues come to market, take advantage of those as well. We'll continue to keep this shorter term strategy at your direction. And as Jesse knows, anytime you need any of these proceeds, we'll allow those to mature, and then you can pull those back in for any expenditures. And if at any particular time there's a desire to move more into this portfolio or potentially move funds from this portfolio back to the operating that you wouldn't need those in the near term, we can always work with you on that as well. But that's the current structure based on those cash flows that we worked on a little over a year ago. I know there's not much on this portfolio, but that's a bit of a highlight there on the strategy. But let me pause and take some direction from you all, or any questions that you might have on this particular portfolio or on the core portfolio as well.
I think we're good.
Yeah, well, I do have one. Sorry, no, I do have one question. So, all our ratings, the S&P, Moody's ratings, are they all supposed to be what's the minimum rating that we're supposed to buy, that you're authorized to buy?
Your minimum is A rating, single A.
Single A? So I just noticed the portfolio is BBB pluses in the portfolio. So I was wondering if that's if does that fall in the, I was just kind of confused on that.
Yeah, let me pull that up here. And you're looking in the holdings. Let me scroll down to the
I
holdings.
was looking at the whole portfolio holdings.
Yeah.
For example, Goldman Sachs is BBB plus A2.
Yes. So that's where the A2 and the A3 rating, those are what qualify those as to be compliant. You have an A, it's got to at least have an A rating by one of the rating agencies.
It just struck me the benchmark is AA to AAA, right?
Correct.
Yeah. So if you have securities that are less than that, then that's going to beat the benchmark, right?
That would be the hope, that if you did have a slightly lower rating, that you would have higher. And generally that benchmark is designed for the longer term. So there may be some times where you do have a single A, these triple B plus securities. We could always look at other benchmarks as well and see what those look like from period to period, but that one generally is the one more closely aligned.
Great. I just want to make sure our portfolio aligns with it.
Or the other way around.
Or the other way around, yeah. Yeah.
If we were to look at, for instance, a benchmark with triple B or single A, they're generally going to have a broader universe of securities that wouldn't fit into our investment program or with your portfolio. So we try to find that balance of a benchmark. It's not going to be perfect, but we do try to find one that's the closest matched. And this generally this AA to AAA is one that's commonly used, but we can always look at other ones. And in fact, next time we meet, I'll have a couple of other benchmarks and we can talk to that in more depth if you'd like to do that.
Okay. Well, thank you.
Absolutely.
On that question, so if we're only allowed to buy A or higher, why do we have triple B plus?
Oh, because this one, it has the A rating by one of the rating agencies. So that meets the compliance.
I see.
Yes. Great question. I'm glad we're having this discussion. And that's by code as well, and as well as your investment policy. Yeah. And I know I mentioned it earlier, but worth mentioning because we put a lot of value into it and resources as a firm, that we've got credit analysts that look at all of these names and review them before they're allowed to be purchased by the portfolio team, which is a separate group of individuals. So we do put a lot of value in that, that they're not just buying it based on a yield and rating. It does have to go through a review process here at PTMA.
What's the longest holding that you have in terms of years? You said our target is 1 to 3, is that right?
In this portfolio?
In the long term.
Yeah, in the long-term portfolio. So our longest is going to be, if we look at the maturity distribution chart, where we've got a small percentage out here in this 4 to 5 year area.
Mm-hmm.
So let me just pull that up here. I'm just doing a sort here. So your longest right now I'm looking is just over 4 years. We've got a corporate note that matures in, I can't believe this seems like a lot longer than 4 years, but it's just under, let's see, March of 31. So just under 5 years, 4.5 years or so. Part of this, we generally wouldn't have, I mean, and not that there's anything wrong with investing out to 5 years is very common in the public sector space. We do it in many of our portfolios, but you may recall this portfolio had gone through a couple of strategy changes. And at first it was 1 to 3, and then we shifted to more of a 1 to 5 year strategy. And then the decision was to and I think part of that all came back to, well, we've got some capital project needs over time. Let's move 20 million into the short-term portfolio, and then let's utilize a 1 to 3 year strategy versus a 1 to 5 because of potential cash needs down the road. And so there was a period of time where it was actually a 1 to 5 year strategy that we were starting to implement. So that's why we see this smaller percentage out there. Again, not a
We purchased that 5 year note before we went back to 1 to 3 because it seems like it feels like it's after.
You're right. That's a great point. So
Yeah, some things I see.
that was right at the beginning, yeah, close to the beginning of this year. So yeah, looks like our team was likely part of the strategy to get this thing to 1.8 years with the current structure of the portfolio. And I'll follow up with the team and get more details on that. But generally, we're going to focus on that 1 to 3 year area. So this was likely just due to balancing out some of these shorter term holdings in the left-hand side of the chart and maintaining that duration by, so I'm looking here, that was in February. And then, yeah, before that was back in November. So it looks like we did that one trade of a corporate note that would have been 4.5 years. But other than that, it was back in the fall. So you're right. That one was done because we started this transition, as you know, late last calendar year. So you're right about that. I'll get more details on that, but generally I expect we'll be in the 1 to 3 year area, closer to that 2 to 3 year area when we're reinvesting. The other thing I want to share is some of these may have a longer final maturity. But if they're an asset back, for instance, they're going to have pay downs. So the actual duration will be slightly lower than that. And let me just show you where that's represented on. So for instance, on this chart, we're showing the ABS asset back maturities here. And we can see the asset backs may have a final maturity, call it longer than 3 years, but because they pay down principal and interest, much like a mortgage back, the duration's a little bit less because you're getting principal and interest throughout the life of the holding of that asset-backed security. So that's one strategy that we utilize as well. And I'm just slowly scrolling through. I'm pausing here. Want to make sure we address all the comments and questions for the portfolios or any direction for us from the commission.
I think
I don't think so far. No.
we can continue.
So on my notes I have for our next review, I'll bring some more details on your benchmark. I'll actually look at a couple other benchmarks so we can look at that and talk to that. Confirm. I'll talk more about talk with the team. But again, generally, I believe we'll be focusing on that 1 to 3, specifically 2 to 3 year area, especially if we continue to see a steepening of the curve. And then I will be sure to have both gross and net of fees for the total return for you all to see.
Sounds good.
Any other thoughts or questions or direction for me or our team?
I don't think so.
Are you all comfortable with the duration strategy that we're talking about, or did you have thoughts on anything? Not that we want to keep changing, but I just want to make sure we have that conversation.
And part of that is the needs of the city, right, in terms of expenditure,
Absolutely.
concerns or thoughts.
Yeah, we're good.
So when you're doing so I don't have any issues with the duration. I just want to make sure that when you look at the fees and net and gross and your advisory fees and all that, I also would like to understand it as a total portfolio also, not just broken up by long-term, short-term. I would like to understand the whole cost structure of the whole portfolio.
Oh, sure. Okay. Yeah. And I can, just so I give you an idea here, I think I can move this up here.
We don't have to do it today, but then next week.
Yeah, no worries. I'm just saying I'm online here, and I'm saying if I can just pull this up, I'm happy to share it. So let me give me one moment here. And if not, I'll make sure to have it ready for next time.
Yeah, and also I guess the other thing we wanted to talk about was the 5-year note that you guys bought too, why you did that.
Yeah, I'll follow up with Dean on that. I believe that normally when we're doing that, it's not frequent on a 1 to 3, but it still fits in with the overall strategy, and that was likely a duration strategy to keep that 1.8 years. And so, let's see here. So we are at 6.5 basis points, it looks like, weighted fee for you all. And the way that that's calculated is 7 on the first 25 and then 6 at above. And so it's based on your daily market value. So I'll be sure to show you how that is. But I wanted to share, this is on the platform as well, where we show you how the fee's calculated.
Sounds good.
And I'll show you your portfolio benchmark, the returns, gross and net of fee for our next review.
Yeah, that'd be great.
When is that, John? The next review? Is the quarter ended, really, but or the next meeting?
This is a quarterly review, right?
Yes.
Portfolio performance.
Or also vast. March.
I see. Okay.
Next is November.
And if you'd like,
Sorry.
sorry, I figured you were tired of staring at the same screen, so I stopped sharing the total return page. But and next quarter, I'd love to see you in person, especially if we're going to go into a little more detail, and I'll bring some more resources with me, and we can dig deeper if you'd like to do that for sure.
That sounds great.
Excellent.
Appreciate it, John.
Thank you.
Thank you.
Have a great evening. Thank you for the time, and of course, thank you for the partnership. I'll bring some more details with us next quarter. Thanks so much.
Thank you.
Then may I have a motion to accept the investment report?
With the requests. We have.
I just have a question, Jesse. On the class report that you gave us, can you tell us if that's net of fees then, since you brought that up? Because you're making You're making almost this a better return on class than you are in your short-term portfolio with John.
I believe it's always based on the gross. But
The fine print says performance results are shown net of all fees and expenses.
But it's not. It's not. They specifically say gross.
On the class.
Class, I'm sorry.
Cause you're making like you're making like 3.6 on class. And if
Yeah.
he takes away his fee on the short term, you're doing better with class. So should we just keep with class or should we pay his fee? I don't know. So anyway, the bottom line is just to find out if class is net of fees or if that's gross too.
That's net of fees.
Is it a one-way street? Like you move things to class, can you pull back anytime you like, or?
I believe for the cap class is next day. It's pretty much.
Okay.
What are the fees for class? What are the fees for class?
I will have
Is it cheaper than the other?
I think it should, but
Oh, okay.
yes.
So it's different types of investments. The Cal class is designed to be short term, so we can access it quickly if we need to. Whereas this is designed for more long.
Mhm.
So be more subject to the interest rate risk. If rates go down with class, the return will go down right away. So did you need a motion?
So moved.
A second.
All right, motion by Commissioner Aros, second by Chair Zhang. I will call the roll. Vice Chair Zhang.
To, oh, sorry.
Okay.
Sorry.
Vice Chair Zhang. Commissioner Chen, Commissioner Fowler,
You're on mute, Ken.
Approve. Approve.
Approved.
Chair Zhang.
Approve.
The motion passes 5-0.
Oh, I thought you were taking over.
Go ahead, continue.
Move on to the KPI.
All right, so this project is part of the commission's work plan to better communicate the city's financials to the community. So our staff and May analyze the city's key performance indicators and compare those outputs with 5 similar cities. So she will share the results and her recommendations. Yeah,
Okay. So good evening, everyone. My name is Hannah May, and I was the finance summer intern here with the city of Los Altos. I go to Boise State University in Boise, Idaho, and I am studying quantitative economics and minoring in applied data science and applied mathematics. So throughout the summer, I've had the opportunity to work on the financial analysis, benchmarking, investment research, and key performance indicator benchmark project here with the city. And today I'll be presenting those findings.
You grew up here?
No, no, just want to live and work here when I graduate.
In California?
Yeah, here in the Bay Area.
The Bay Area.
Yeah. The objective of this project was to evaluate Los Altos's financial performance, resilience, and investment practices relative to comparable cities. So the project deliverable is the recommended KPI dashboard and an analysis for the executive team. As I worked through the benchmarking effort, I started identifying which indicators consistently provided the clearest picture of financial health, resilience, and long-term sustainability. Those metrics eventually became the basis for the recommended dashboard. For other comparison cities, I used Campbell, Saratoga, Los Gatos, and Morgan Hill because they are in Santa Clara County with a relatively similarly sized population. I also included Burlingame because it is frequently viewed as a strong benchmark for financial management and investment practices. As a roadmap for today's presentation, I'll begin with revenues and operating performance, move into reserves and financial health, discuss.
Sorry, can we, like, do full screen? Is that possible? Keep it.
Okay.
I'm sure.
This is a.
That helps, yeah.
Okay.
Thank you.
I think the other slides are a little bit bigger, so. So I'll begin with revenues and operating performance, move into reserves and financial health, discuss investment and management practices, and conclude with the recommended dashboard.
Before you move, you said Burlingame is regarded as financially like a good benchmark.
Yeah, they kind of tend to do, and you can see it throughout the project. So we have a relatively similar size population, and they just kind of hit it out of the ballpark every time. And it's kind of a good, they have a different revenue structure for sure than Los Altos, but it's a nice kind of reach, I guess.
But that's based on your assessment, or is that like a general, some kind of a overall ranking of cities or some third party independent evaluation which says Burlingame is very financially very good?
That was at the recommendation of Jesse and Bo as well, based on like the kind of among cities, it's well regarded. Among finance city staff, it's well regarded.
So you folks have looked at, other comparable cities, and you feel Burlingame has done things very well.
Yes, fortunately, they are similar sizes as 30,000.
How much does size matter? City which is, let's say, 3 times as big as us or twice as many people. A lot of the KPIs, would they be like normalized by population per capita or anything like that, or not really?
It depends. A lot of it depends, right? So I think, especially as you get a bigger city, they'll also have, a lot of them have larger commercial areas. And so that is one of the trickier things about Burlingame. They have a slightly bigger commercial base. But generally, like that's one of the things. So when we identify cities, and that's why we frequently compare ourselves to these cities, is because the same population, similar structures in terms of residential versus commercial.
But that's primarily on the revenue side, right? How much revenue is coming in?
But yeah, and so that's also the other thing as we look at the expenditures is, and it gets tricky because some of these cities, the city of Los Altos has its own police department, but some of these cities don't, right? And so how do we compare that? And so I think Hannah in her presentation will kind of talk a little bit about that. I will say these are 5 cities that we generally often compare ourselves to, despite some differences that they might have.
Okay, so one of the first findings that stood out was the degree to which Los Altos relies on property tax. So today, property taxes account for approximately 54% of general fund revenue as of fiscal year 25, and is among the highest levels in the peer group. Only Saratoga shows a similar level of dependence. The significance of this finding isn't that property taxes are problematic per se. In fact, property tax is generally one of the most stable and predictable revenue sources. However, it does mean that Los Altos' financial performance is going to be more closely connected to property values than peer jurisdictions. And just to orient you a little bit, so the green line at the top is Saratoga. That orange one, the thicker one, is us. And then we've got Los Gatos with the purple, and then red is Burlingame, blue is Morgan Hill, and then yellow is Campbell. Once I understood kind of where revenue comes from, I wanted to determine how effectively cities convert those revenues into financial results. So the chart on the left shows revenue per capita. Los Altos performs very strongly relative to most peer cities and has experienced steady revenue growth throughout the past decade. I'd like to turn your attention to the chart on the right, though, which measures operating surplus per capita. This is simply the difference between revenues and expenditures by population. And what stood out is that Los Altos consistently generates positive operating expenditures or results, excuse me. So in the past fiscal year, Los Altos generated about $504 more revenue than expenditures per resident, the highest among the peer group. The broader implication is that Los Altos is consistently creating financial capacity. That naturally raises an important question. If the city consistently generates surpluses, what are those resources ultimately being deployed to? I also wanted to evaluate financial health beyond annual budgets. So the chart on the left shows pension funding ratios. Generally speaking, higher funding ratios are preferable because a greater share of future obligations is already funded. The chart on the right shows net pension liability relative to annual revenue. Most cities fall within a pretty narrow range, as you can see. Los Altos carries the second lowest net pension liability relative to revenue among the cities reviewed. But one thing I'd like to note is that Saratoga, which is that green line, like I said, they don't have a CalPERS safety plan because they are the only one in the peer group that doesn't have either a police department or a fire department. So in some ways, Los Altos is kind of at the top of its peer group. And this is very important because it indicates that the city has a strong reserve position and it is not being offset by unusually large pension liabilities. Earlier, we saw that Los Altos consistently generates surpluses. The slide begins answering where those surpluses have gone. So the reserve ratio has increased dramatically since 2021 and now places the city among the strongest reserve positions in the peer group, as we can see from the chart on the right. A significant portion of these revenues above the policy minimum are being accumulated to support the future police department facility. The chart on the left looks at capital investment spending per capita. Others appear more willing to direct resources towards infrastructure investment, while Los Altos maintains a slightly more conservative approach, a more balanced approach, one might say. After looking at reserve balances, I wanted to compare those balances against city's formal reserve policies. So Los Altos currently maintains reserves equal to approximately 49% of expenditures, despite a policy minimum of 20%. Morgan Hill shows a similar pattern. Campbell remains much closer to its policy target. What this comparison highlights is that reserve ratios alone don't tell the entire story. The broader takeaway is that Los Altos currently maintains flexibility relative to its policy requirements.
What does that mean? Burlingame uses designated reserves?
Yeah, so they have different kinds of, they kind of operate similar to Los Gatos. So the reserve ratio that you see that has actual, like some of these numbers are based on the unassigned reserve. And Burlingame does have 10.1% into their unassigned reserve budget, but they have other reserve budgets as well, separate from that. So while yes, they do have 10.1, it's not the full story.
I mean, we can just add up those assigned reserves percentages into that 10.1% and see a comparable picture. Like
we could, for sure. It is something that in my larger KPI dashboard that I did do over the summer, I do have on hand if that was something that we wanted to look into. But because Los Altos measures their reserves in terms of unassigned, I wanted to just look at unassigned. So this slide looks at the other side of the revenue diversification discussion. Compared with most peer cities, Los Altos receives a much smaller share of general fund revenue from sales taxes. Importantly, this is not primarily due to tax rates. The underlying tax rate is generally similar across cities. The difference reflects variations in economic activity and retail base. One implication of the structure is that Los Altos is less vulnerable to changes in consumer spending, and it reinforces the earlier observation that property values play an unusually important role in Los Altos's financial model. And I'd like to preface the start to this slide by saying that the stuff on this slide is just for Los Gatos. It is not for our city. So something I found a very interesting document on the Los Gatos website. It was a long-term 10-year financial forecast prepared by a group of consultants hired by the city. And what they found was that expenditures were going to outpace revenue over time, leading to a 7.5 million projected deficit by 2036. The primary driver for these rising costs is pension liabilities, healthcare, and personnel costs. Los Altos has a much lower pension liability than Los Gatos historically, but if this forecast is correct, it would also face higher healthcare costs and personnel costs. The consultants estimated that property tax revenue will grow at roughly 5.2% annually in Los Gatos. However, they also estimated that healthcare, other post-employment benefits, and other benefit-related costs are projected to grow at even faster rates than that 5.2%. My point is to say that looking at this result, the combination of property tax dependency and a conservative approach to finances will continue to benefit the city for years to come and hopefully avoid a deficit like this one. Moving on, the other obvious revenue source that is within the city's control is investment management. The cities of Morgan Hill and Burlingame both have a substantially larger portfolio than Los Altos. Additionally, every city uses local agency investment funds or LAIF in their portfolio. Only 4 cities, however, Burlingame, Morgan Hill, Los Gatos, and Los Altos, use some sort of actively managed portfolio, and for that reason, I'll be focusing on those. So all of the top performers here on the graph use that actively managed portfolio.
So Morgan Hill is comparable in population to Los Altos, but has more than double the size of investment portfolio.
Yes.
Like triple.
Yep, and I will do an even larger breakdown, but yeah, they have about twice as much in their investment portfolio as what Los Altos does, and about the same size of reserves as well.
What explains that?
Morgan Hill, there's a couple, so they have a really strong reserves right now because they are planning for some infrastructure changes. The investment portfolio, my guess is because they have a really high pension liability, they're trying to use that to kind of offset some of those costs. They're probably estimating some sort of deficit similar to Los Gatos is my guess.
So they are not funding the liability, they're not reducing the unfunded pension liability actively, but just putting them on the investment portfolio instead.
Yeah, that I'm not entirely sure because I didn't necessarily go through and read like I don't have access to that information per se because this was all done on publicly available information. The only it's kind of when you look at the whole the image as a whole of Morgan Hill, it's kind of what makes sense. But my guess is it has to do with future needs of some kind, including the fact that they have a pretty high pension liability rate. So this slide compares 3 key characteristics of each portfolio for the quarter ending in March 31st. We've got portfolio size, overall yield, and weighted average maturity for each managed portfolio. The first thing that stood out is the difference in portfolio size. So Morgan Hill and Burlingame maintain portfolios that are roughly 2 to 3 times larger than Los Altos, despite serving communities that are not dramatically larger. The second observation is that portfolio size alone does not determine performance. Los Gatos has the smallest portfolio shown here, yet it generated the highest yield. The third observation is weighted average maturity. So Los Altos has the second lowest weighted average maturity, reflecting its generally conservative approach as liquidity is important as a city. Overall, this slide reinforces the idea that different cities are achieving competitive results through just different investment strategies. So now moving on to kind of
Sorry, let me go back. So Los Gatos, so you said that some of these were actively managed and others were passively?
Yeah, so
So the,
So the weighted average maturity is just for their professionally managed portfolio. The yield is overall yield of their whole thing, LAIF, Camper, CalClass, and their actively managed portfolio.
So that's yield, that's not return.
No, this is their overall yield, their percent yield. So Morgan Hill stood out, obviously, as mentioned earlier, because of the size of its professionally managed portfolio and the size of its overall portfolio. So over 80% of the portfolio is invested through a professionally managed account. That what makes this particularly interesting is Morgan Hill's broader financial profile. So Morgan Hill carries one of the larger pension burdens within the peer group. Given that context, a strong emphasis on professional management and diversification appears logical. The yield is slightly lower than Los Gatos, but the portfolio appears designed to prioritize stability and consistency. To me, Morgan Hill represents a portfolio that leans heavily towards safety and diversification while still generating competitive returns. Next up is Burlingame, and they stood out again because of the scale of their investment portfolio at relatively 3 times the size of Los Altos's. And at 288 million, it is the largest portfolio in the comparison group as of fiscal year 25. And unlike Morgan Hill, which is heavily concentrated in a managed portfolio, Burlingame distributes assets across several vehicles, including Camp, LAIF, and a primary investment portfolio. That structure creates substantial liquidity while maintaining strong diversification, likely because they have a relatively low reserve requirement and their unassigned fund is below target at the moment. To me, the broader lesson from Burlingame is that portfolio size and diversification can create flexibility without necessarily sacrificing performance. Los Gatos also stood out because of their really good yield. So the portfolio is primarily invested through managed investments with smaller allocations to LAIF, mutual funds, and cash. From a pure return perspective, Los Gatos appears to have achieved some of the strongest results among peer cities. Los Gatos is simultaneously forecasting future structural deficits while generating strong investment returns and performing extensive long-term planning. That suggests they may view investment management as one component of a broader long-term fiscal strategy. So after viewing the peer cities, I wanted to understand where Los Altos fits within the group. So one thing that stood out immediately is that Los Altos performs quite well from a yield perspective at approximately 3.78%. The portfolio generates returns that are competitive with many peers, despite maintaining a relatively conservative structure. Los Altos also maintains significant liquidity through LAIF and CalClass and continuing to use a managed portfolio. However, compared to Morgan Hill and Burlingame, Los Altos is maintaining a substantially smaller overall investment portfolio. That doesn't necessarily indicate weakness. Investment decisions don't occur in isolation after all. Los Altos has significant planned capital obligations, including the future police department facility, which naturally influences how funds are allocated. Also, I'd like to point out that our portfolio has been growing significantly throughout the last fiscal year, despite allocating for that new police station. My overall takeaway is that Los Altos already maintains a strong and competitive portfolio, but the peer city analysis provides useful insights into how other cities balance reserves, investments, and liquidity. In summary, Los Altos is in a strong financial position with much of its income coming from property tax. Rather than creating an extensive list of indicators, my goal was to focus on measures that tell the most meaningful story over time. So the general fund revenue and expenditures provide insights into operating performance. Investment portfolio metrics provide visibility into liquidity and financial capacity. Pension funding ratios provide perspective on long-term liabilities. And together, these measures create a simple but effective framework that can be tracked year after year. This is a significant step in moving beyond a one-time benchmarking exercise and establishing a consistent way of monitoring long-term financial health. Thank you. Do you have any questions?
You're gonna build that before your internship is over, right?
It's already done. It's in, I got 10 years of data for, like, there's a really large document with data clear back to 2016. With like tons of different indicators. And then I have that more condensed one with, those 5, or 4 rather, but and then I have a condensed one that.
But it will not refresh as.
No, it's on Excel. So you do have to go in and gather it from the ACFR every year. Yeah.
Once you have the KPIs, then does it make sense to broaden the peer group? So like any city, like you just pull these KPIs from across the country.
Yeah.
Or be too much noise.
The only problem is that because Los Altos is in such a unique area and is dependent on property tax, I think it could be potentially too much noise if you took in other cities across the country.
Mm-hmm.
It might be worth adding in some other cities nearby, but I don't know about necessarily broadening it beyond the Bay Area per se.
I think we're thinking about the dashboard and the tracking of these areas. That's wonder if we want to think about best in class, right? For what cities are doing this the best ways, and approach it that way rather than just saying we want to try and be as good as other cities our size. Maybe we want to be as good as a big city.
Yeah, for sure. It also depends so much on the needs of the city, right? Like while like Los Gatos is so heavily dependent. Well, actually take Campbell, for example. Campbell has such a high income from sales tax alone, and it has the highest in the peer group. But they are also in a deficit right now, for example. So they just have different needs. Also, some of these, Morgan Hill has a lot more retail space, Targets going in, et cetera. So it depends very dramatically on the needs of each city. I think it is useful though to measure, because the last thing you would want is to drastically lag behind cities that are near you in a certain revenue source or in investment management. Like if I was looking at this maybe from the perspective of, well, Saratoga doesn't have very high pension liabilities, but Saratoga or Campbell, they don't have an actively managed portfolio. You might look at this and say, oh, maybe they should look into it, which I'm sure they have. But yeah, it's just interesting.
Yeah, I think that that's part of the having the dashboard is part of the that communication, right? So that everybody in Los Altos can understand the uniqueness of the characteristics of our city. I think it's pretty well known, that we have a big delta between real estate and our sales tax. But I think kind of the purpose though is to say, given our environment, given what we're doing in Los Altos, are we being successful financially?
Yeah, for sure.
Right. And I think that's kind of the purpose of the dashboard is really so there's complete visibility of what's happening with this. I mean, one of the things in San Francisco, you can track every penny of spending, right? You can go into their website, look at a PO, go into the PO, see who has paid what, and when. So I think, that type of openness and transparency is also important.
Yeah, for sure.
I'm sorry, can you go back to the expenditure over revenue slide? That was really good. I really appreciate this summary.
Yeah.
I'm just wondering when you see the peaks and changes,
Mhm.
the next slide, the next one.
This one right here?
Yeah, the revenue minus expenditure. I
Yeah.
wonder if we can somehow capture expenditure that are like an annual expenditure versus a long-term capital improvement
Mhm.
and do something on a per capita basis too. Because what this is telling me as a citizen of Los Altos is that I'm contributing what $500 a year to the future of Los Altos, right? When it's
Yeah,
revenue
pretty
minus,
much.
which
And
is
like,
really good, which would be really nice to compare to other cities like that. But
yeah.
I'm just worried if somebody looks at this and we start making big capital expenditures, does that somehow go down per capita? Does that make it look like we're not investing for the future or?
I don't think it would because the thing that would go down would be that, let's see, where is it? The reserve ratio, right? Because for like the
Yeah,
police, we've saved up for it, and that's why our reserve is so high. So you would see that probably more shift towards CIP, but for the expenditures and revenue, it's just for the general fund. So
right.
I think, uh, so I think
So, so
yeah, go ahead.
I see your point. The capital expenditure per capita would tell the citizen that we are making future investments. But then if we go over to the other slide and then suddenly we have these big expenditures that wipe out our revenue, is that how it'd be captured? Is the expenditure, I guess my question is the expenditure include construction or capital expenditures?
Expenditure would not be captured in this revenue minus expenditure per capita graph because it is just for the general fund and CIP would
Okay,
fall under, right? Yeah.
okay,
Where,
okay.
where, Ken, where you might see an impact on this slide is if we say we have to borrow funds to pay
Yes,
for a police station or whatnot.
yes.
And we have a dedicated revenue source, then we would see the revenue minus expenditure. Well, we might see the revenue versus expenditure here drop because we're now paying an extra expense that we weren't paying before.
Right.
Is that?
Okay.
2022 is probably just, it was a down year for our revenues or
2021 and 2022 was like very low in general, like investments, like Morgan Hill's the only one that didn't have like a negative investment return that year. Like if you look at it as part of their income anyway.
yeah, I'd have to look
The
at it.
line looks okay, so it's some expenditure hitting the right.
Yeah, I mean, I'd have to look back and see exactly what the difference was.
So this figure of revenue minus expenditure, it can be misleading though, right? I mean, a city might decide to shut down services for their constituents or residents, and all of a sudden you have a very nice revenue minus expenditure. I wonder if there's a way to make it a little bit more complete by indicating like the services a given city is providing to its residents. I don't know if there's a way to capture that also.
There's a social ROI. So
I don't know what the answer is, but when I look at it, I feel like this is a little bit artificial because, yeah, I mean, we can decide to spend only half the money we're spending for services, and all of a sudden this number will jump. But so that's good. Probably not. Yeah.
Yeah.
But I mean, I think that's a really good point is, how do we know, I mean, I hate to use ROI, but, what is the money, the taxes we pay? How does that benefit the citizens and how do we measure that?
Yeah, I mean, in terms of services, I think the best one would be capital improvement projects is probably as far as like what's in this presentation is probably the closest thing to that. Or
Yeah, it's almost getting to soft measures here, right? So how do citizens feel about the financial expenditures?
I mean, generally speaking, at least based on, so, two of the other interns that I worked with this summer, Leonard and Mira, they were out talking to the public about the potential park measure, and they, generally speaking, the sentiment, well, let's see, of the people who kind of had doubts about the park, their point of contention was mainly the city doesn't need to spend on this. So it seems to me, at least, and admittedly, that is not, purely great statistical work to go and sit at a corner, right? That's an issue, but at least from the feedback that kind of we got as an intern cohort, it is that either people are happy with how we're spending and allocating to the needs of Los Altos as it continues to grow, or they want us to continue to take a pretty conservative approach and really not spend very much. Which is great, because the way that things are right now kind of meets both parties, right?
So you got the list of cities from John and Jesse, the 5 cities, the peer cities.
Yeah, from Bo and Jesse, yeah.
And is this something that you created kind of for the study, or this is a peer group that we had used in the past, the long-standing peer group?
We picked out of like neighboring cities, similar sizes.
I'm just trying to see if there's a sampling bias here that, we didn't just, is there an objective criteria that we used, or is this?
No, so if any city was under, I think the cap was 45,000. If any city was under 45,000 in Santa Clara County, it was included. So
It was included.
it was included. Yeah, there's only 6 in Santa Clara County that are below that 45,000. And then the sampling bias that I will say would be present is the fact that we did include Burlingame. So that would probably be the closest. But other than that, we kept it pretty objective.
So what's the next steps?
Implement the KPI.
Yeah, mainly just keep track of it, probably with the next ACFR when it comes out in November-ish, right? Then update that spreadsheet.
So what are the KPIs?
We've got general fund revenue and general fund expenditures. We have investment portfolio as reported on the ACFR, and that'll also report how many assets are liquid and how many are non-liquid assets. And then pension funding ratio. Yeah, it's those 4 or 5 metrics.
So everybody
started the KPIs.
Okay,
Yeah.
so everybody in this room is kind of a financial person. We all have corporate drums and we discuss this stuff all the time. So, but I'm more concerned about the kind of, average citizen and being able to communicate in an effective way, the finances. So I'm concerned just those numbers. It doesn't tell the average Joe what's going on.
Is there a better way or a less technical way?
Yeah.
To explain, yeah.
And that's what I was thinking about best in class, right? In terms of that approach, in terms of how we communicate to everybody about the quality of our finances here.
I also figured out why we had a huge dip in 2022. That's because we made a payment towards our UAO. And that comes out of the general fund.
Great, thank you very much.
Thank you.
Very good, thank you.
Did you have fun?
Yes, I did.
Are you gonna come back for another internship or are you graduating?
I graduate next year. Yeah, I graduate in May 27th. So
This makes you want to move to Los Altos, right?
yeah, no, I do like it here. It's a very nice area for sure. Yeah, so I'm open to kind of anywhere in the Bay so it was nice to be able to explore the South Bay a bit for sure.
Awesome.
That's good. Do we need any action on this one?
No.
Next is the unclaimed funds policy.
So the city council adopted the unclaimed fund policy in June 2018. The state report and the full policy are included is in the packet. State is asking the commission for any questions, comments, or suggestions.
I just had one question on it. So I didn't see it in there, maybe it is. How often do we cycle? Like once a year we go through and clear out checks or a sheet, or every 6 months or rolling, or?
There's no like designated, like the police does not say anything about frequency,
Yeah.
but we try to do it periodically. So last time we went to the council was 2019.
Mhm.
And then the next publication was last year, January
Oh, not the
20.
policy, I mean, just the,
Yeah, the publication for the public, for
You're
the
right.
unclaimed
yeah,
check. It was January 2025 last year.
okay,
Yeah, and then now we are working on the rest of them.
okay.
So every 2 years.
In a couple of years, with the pile this high. That's how my desk looks, yeah. You look good to me.
I have no value add here.
Right. This is the information also. Email to me, there's nothing.
So the ones you posted, the 89K was from the last batch?
So 88,000 is everything more than 180 days. In and out of 88,000, I think 50,000 is more than 3 years, and that's what I'm working on. We are working on.
I see. Okay. Last agenda item today is the audit.
Yeah, so this item is about the city's annual audit for fiscal 26. Badawi and Associates is the city's audit firm, and we invited them to the meeting, but they were not available. So I spoke with them directly, and the details are included in the step report. And the four main areas are the city's new ERP system implementation, new GASB requirements, and revenue recognition, and expenditure testing. So the city is asking the commission to share any additional concerns or comments on the focusing area for the audit.
Did they give you any feedback on why they picked payroll expenditure, or when have they tested that cycle before, Jesse? Do you know?
There's no comments, but we will start the final audit in September. So they will more, yeah, for deeper testing on that.
Okay.
And this is the first time we're going to do it with the new system, right?
Right. So they're using IT specialists for the IT audit.
Mhm. No? Sure, there was a meeting.
Oh.
Yeah, I mean, so there's no reports or future items. That's all we have.
Looks like not.
Okay.
Cool.
You have to say that one.
Oh, well, okay. Meeting is booked at 7:52. Thank you.
Thank you.
Thank you. Are you going to publish that on the